So I'm recording this one, and I am going to start by muting all y'all. Let's get a mute button on.
So we don't have to mute ourselves, right?
Penny, you should probably mute yourself because you kind of get out of control sometimes, so we need to make sure that. All right, y'all be. Yep, on that note, goodbye, Penny. And you will have the ability to unmute yourself, but you all are muted. And then I want to pull up my chat box real quick so that I can see if you guys have questions, post them in the chat box. And away we go. All right. So happy 6th of April, everybody. It is another amazing week in the mortgage and real estate shelter in place. Super excited to be able to keep you guys updated with all of the changes that are going on. So I'd like to welcome my cohort, Jeff Lee. Jeff, you may feel free to unmute yourself and say hello real quick. Not working yet, Jeff. Need help? Let me help you. There you go. I've unmuted you. Jeff, I still can't hear you, bud. There you go.
Hello. Can you hear me
Much better. Yes. All right. For those of you who were on the call last week, Jeff's GoFundMe account worked. His mic sounds much better, doesn't it?
That's only because I'm on my iPad now.
All right. Fair enough. So Jeff, introduce yourself real quick.
Jeff Lee, Chicago title, 27 years in the business, I think.
Got it. All right. So Jeff's going to fill us in on a little bit of the constant changes that keep happening in the title and escrow world. Good news or bad news, I'm going to monopolize a majority of this hour. Depends on how long it takes. As I said, last week was an hour. We had a lot to cover. The truth is today I have an equally lot to cover and very little of it's repeated from last week. So let's go ahead and get started. First thing is, what are we going to talk about? So I'm going to talk about where rates are right now and where they're going. We're going to talk about some changes to loan programs. We're going to talk about why guidelines are tightening and what's happening in the mortgage world. We're going to talk about servicing. It is the next domino that's about to fall. We're going to talk about forbearance issues that consumers need to know about. I'm going to talk to you about SBA loans, not because I do them, but because you guys need them. And I'm going to explain to you some of the details that you need to know about how to get your personal finances in order. I'm going to give you some updates from the title and escrow world. Actually, Jeff's going to give those to you. And then my plug, I am doing weekly educational seminars for our clients, your clients, my clients, and I'm going to introduce to you what those are and hopefully have you help me fill those with people that could use that information. So here we go. Mortgage rates. Guys, the last month's been the biggest swing in mortgage rates I've seen in my 19-year career. I didn't talk much about this last week. I will tell you, if you missed last week's seminar, it was the first of the webinars that I have done in this series. It is on YouTube, so go to youtube.com/JohnLoanKing, and you will see my webinar from last Wednesday, and you can watch the full hour. So what I want to talk to you today is just how volatile things have been. And so what you're going to see here is you see a big old green line around March 20th or so. That is the biggest, actually the day before that was an even bigger day of movement. What you're seeing is the movement of interest rates from the beginning of the day to the end. And what I want you to compare it to is, let's go all the way back to February 24th and that little line that you see on the far left. It looks really, really tiny, but it's only tiny by scale when we are comparing it to the interest rate movements we've seen in the middle of March. What I want to point out most importantly is the absolute best day of rates is this red line right here, right about March 9th. You see where it touched what looks like almost 103.63. I don't expect you guys to understand what those numbers mean, but all I need you to know is that a high number on this chart means rates should be really, really low. And on that day, around March 9th, what we had is 30-year fixed at 2.99. We had 15-year fixed at 2.75. What you notice is the next, 4, 8, 9 trading days, the rates were worse. But ever since March 23rd, the market has been better than it was on March 9th, yet the rates have been worse. There is a huge disconnect between the interest rates that Wall Street is charging mortgage banks and the interest rate that mortgage banks are charging to consumers. Rates should be in the mid to low 2% range right now based upon where the market is at. I'm going to say that in a different way. We all have a basic understanding of how the price of a barrel of oil impacts how much you pay for gas at the pump. We've seen it in the last month. The price of a barrel of oil has plummeted, and so has the price we pay at the pump. But what you're noticing is here, what you're staring at in the mortgage world is essentially the price of our barrel of oil. And remember, when the price goes up, the rate goes down. And so the price of what mortgage companies buy mortgage bonds or sell mortgage bonds for, we're getting a huge premium on them. But there's other reasons that I'm going to explain through the rest of this time together on why there's a huge disconnect right now in interest rates. It is not being passed along to the pump, even though the price of a barrel of oil has dropped significantly. A lot of complex things that I'm dumbing down, and I don't mean to say dumb down disrespectfully, but I'm simplifying the concept. But I encourage any of you on the call right now, go into chat and type me a question if you have a question that you want me to answer. If it's pertinent to what I'm talking about right now, I'll address it. If it's not, I'll hold off and address it at the end. But definitely, rates should be lower than where they are today. Personally, I think we should probably be seeing rates in the mid to low 2% range if everything else was equal. The problem is nothing is equal in today's world. Nothing is normal. So here's my advice to clients. Very simply, if you're buying a home, lock it in and don't look back. Rates are super good. Right now, I locked in a client today at 3.375 on a 30-year fix. That's a super, super good interest rate. Okay, is it the 2.99 I saw 3 weeks ago? No, but it's a super good rate. And if they try and wait to time the market, they're going to deal with volatility that's going to bite them on the backside, because we're going to see rates change significantly from day to day and week to week, just like we saw in the month of March. But I'm also significantly changing my advice to clients that are looking to refinance, and it's actually benefiting you on the mortgage rate side. Summit Funding and a lot of other mortgage banks have made the proactive decision: we will not lock refinances until the loan is final approved. And the reason is simple. It does two things. It decreases our cost for interest rates, because right now there's so much volatility that we're taking the risk on our end that we don't know where rates are going to end up in the end, and we've got a huge hedge cost. And I talked a lot last week about hedging. So this is how we're decreasing our hedge cost, is by not carrying a bunch of refinance locks. But for the so we get to pass on better rates to everybody because we don't have that huge hedge cost. The second thing it's doing is it's allowing the person who's refinancing to lock for a shorter period of time, because now we only need to lock them in for 15 days instead of for 60 days. And so the rate is significantly lower, and we can time our lock. Because when we see huge volatility in interest rates, we have the ability of 2 months from now and I'm ready to lock and rates are up for the week. Great, we just wait till next week to lock in your rate. It takes a little bit of faith on the side of the consumer, but it works out way better for everybody, and that's the strategy we are employing. So that's what we're doing as far as mortgage rates. Changes to loan programs. Guys, jumbo's almost completely dead. Literally almost completely dead. As of last week, even on Wednesday, so I did this call Monday and Wednesday. As of Wednesday, I still had 2 out of 11 companies that I could do a correspondent loan, meaning I underwrite it, I approve it, I fund it, and I sell it to that jumbo bank. I still had 2. Now, 2 weeks ago, I had 11. As of Friday, there's only 1 man left standing. Chase is the only bank that is still buying jumbo loans from correspondent lenders like Summit Funding. Now, a lot of those banks are also shrinking what they're doing on the retail side. But the truth is, what I see happening right now is jumbo loans are going to be the territory of big banks. They're going to be the only place you can go to get a jumbo loan. And government, FHA, VA, Fannie Mae, Freddie Mac, those are going to be the territory of mortgage banks like Summit Funding. I really do see that divide coming to play, and it's very, very true right now. I read this morning, Wells Fargo not only stopped doing refinances and purchases with correspondent lenders, in other words, not employee or lenders that work for their bank, but they also took the step to not refinance a mortgage for anybody unless they have $250,000 or more on deposit at Wells Fargo. So if you have a customer that has a jumbo loan and they just want to refinance their loan, unless they bank with Wells Fargo and have $250,000 of deposits with Wells Fargo, Wells won't do their refinance even with their retail in-house lenders. This world is really tightening a whole lot. FHA and VA loans, the rules are continuing to shrink. Summit did constrain or increase our minimum credit score on FHA to 620. A lot of my peers are at 680. Some are at 660. A few of them are at 640. I really don't know anybody that's lower than a 620 credit score. Summit and most banks have made a decision to put down payment assistance loans on hold. They represent way too much risk right now. I explained in the meeting last week a little bit of why that's happening, but I'll very simply say, if we don't get it sold within 45 days, then the down payment assistance company goes into our checking account and pulls the money out to pay for the down payment assistance. And the process to get loans sold right now is taking longer and longer. I didn't put it on my slide, but I'll tell you one of the things that's changed effective last Thursday. Every loan that Summit Funding closes will be serviced by Summit Funding. Now, in a lot of ways, you'd wonder, well, why is that a big deal, John? Because previously we had held maybe about 1/3 of our loans and we sold about 2/3 of them because big servicers, PennyMac, other banks were paying a huge premium to us. So why not turn over the servicing? Because we can make a big profit up front instead of holding the loan and making money long term. Nobody's buying servicing rights right now. That's a major issue if you're working with a bank that does not have the ability to service their own loans, because they're going to run out of the ability to fund loans because they cannot sell the loans on the secondary market. Nobody is buying the servicing rights, and I'll explain in a couple of minutes why that is. We're not doing any renovation loans or holdbacks right now. A big piece of it has to do with the fact that we can't be confident that an appraiser is going to go out and confirm the work is done. We also can't be confident the homeowner is going to let an appraiser, or excuse me, let the contractor into the house to do the work. So up until last week, we were aggressively allowing for escrow holdbacks if work needed to be done, that we would just let the homeowner take ownership of the property. We'd hold back the amount of the bid plus a 50% markup holdback in case there's cost overruns, and we'd have the work done after close of escrow. But we've been bitten from a few homeowners who have closed escrow and then decided, well, you didn't expect me to actually let a contractor into my house during the shelter in place, did you? And now we've got a problem because we have a loan that we can't sell. And they're blaming us because how dare we expect them to let somebody into their house, but they also signed a form that said they agreed they'd get the work done within 14 days of closing. When they really wanted their keys, they'd sign anything, and then after the fact, they changed their tune. I don't blame them, but it means that's why we can't do any escrow holdbacks or renovation loans. Another huge change, and this is not from Fannie Mae or Freddie Mac, but it is a lender by lender change, but we are getting very concerned about rental income. Why? Because 25% of the American population might be out of work and they won't be able to pay their rent. So if I'm qualifying somebody to buy a home or refinance a home and we're using rental income to qualify, we're going to have a hard time justifying why we use that income if we can't prove that person is actually making the rent payment. So for Summit, our rule is the tenant must sign an agreement that they're not going to ask for a rent forbearance, and we must be able to prove the current month's rent has been paid. If I can't do both of those things, I can't count the rental income. That includes a client I had last week that was trying to convert her current home to a rental and buy a new primary home. I couldn't count rental income from that because she didn't have a tenant in place for me to get a lease agreement or an agreement that they weren't going to forbear and to prove they've made a payment because there's no tenant. So it takes the ability to count rental income from the house you're moving out of off the table for the foreseeable future. All right, don't forget to post in chat if you have any questions about any of this. All right, good news on loan programs. I made this page special so that we can add all of the amazing good news about loan programs, and I've got one thing. So drive-by appraisals, Fannie Mae and Freddie Mac had said if we can't get an appraiser out there, we are allowed to do a drive-by. FHA last week also signed on to the same thing. So we can do a drive-by appraisal on FHA. What you have to be clear about is we cannot request it to be a drive-by. We have to request it to be a full appraisal, and if the appraiser is unwilling to go into the home, or if the occupant of the home is unwilling to have the appraiser in the home, then and only then are we allowed to do a drive-by appraisal. All right, Christina's asking, how is a drive-by or desk impacting value? It's not. It's Christina, the value is being impacted by the sales price. of the comps. So, and let me say this in two different ways. The question you're asking is, are we seeing low values? I'm assuming that's kind of what you're asking. Feel free to unmute yourself if you want to clarify or type it into chat. So I haven't yet had the need to do a drive-by appraisal. So I've got to be honest, I don't know if it's going to impact whether or not we get value. I will tell you the good thing on a purchase is that the appraiser knows what the target price was. And so they're more likely to make some assumptions based upon the fact that you got a buyer and a seller agreeing to sell the home at that price. So I follow a lot of industry blogs. I listen to a lot of my peers that are talking about challenges. Nobody's brought up concerns yet about low values on drive-by appraisals. So hopefully that answers your question. If not, then feel free to post a further clarification. Okay. So I talked about this last week on Wednesday's call. I need to be super clear about this being a major issue. Verification of employment. Let's go back, Penny, real quick. What are they charging for a drive-by appraisal? $1 million. I have no idea. So I honestly don't know. Equal to or less than what the full appraisal is. That's all I can tell you. I haven't done one. Okay, so verification of employment. We must be able to contact the employer the day of or the day before closing. Now, this is a lender by lender guideline. Some lenders are a little more relaxed about it. Some lenders are saying you only have to do it. The rule says 10 days before closing, we have to verify somebody still has a job. But we as a lender are on the hook to make sure that nothing is different about somebody's ability to qualify up to the day we close escrow. So a lot of banks are requiring it within 3 days. A lot of banks are doing the same thing we're doing and requiring it the day of or the day before. And we have to confirm two things. We have to confirm that their hours and pay of the home buyer have not been negatively impacted. And we have to confirm the company is still operational. And I need your help in getting the message out to your borrowers. They have to have a contact person within their employer who's willing to answer those questions. And they may answer them on a Monday because we're planning on funding and recording on Tuesday. And if that gets delayed until Wednesday, then guess what? On Wednesday morning, we've got to call back that same person and ask them the same questions again. And I strongly encourage your clients to remind the person at HR, please don't divulge more information than necessary. We've had deals fall apart, gang, where somebody has said, well, yeah, right now there's no impact, but we're having a meeting next week, and I think we're going to talk about everybody having to cut back their hours, and we'll know more next week when that meeting happens. That loan didn't fund because we have knowledge that the income may be changing, and we have to wait until next week. Okay, so answer like you're on trial, yes or no questions, yes or no answers. We want to do everything we can to help people who have good income and have the ability to qualify to get their mortgage. Self-employed is creating bigger challenges. So we have a COVID disclosure that we've just created that they have to sign as part of the doc package that said I am self-employed and I attest to the fact that my income has not been negatively impacted by the COVID shutdown. On top of that, we need a third-party verification. That's a CPA or someone else, some other method of verifying their business is open and active. And the funding department will typically call the borrower. We've had deals fall apart because we've had borrowers who have been afraid to tell the truth about the fact that they're working even though they're not considered an essential business. And so they've told the funder, well, yeah, except I'm not allowed to do this and that and the other thing, and so I'm not doing it because I'm not allowed to, and that just killed a deal. And so we've got to be on the same page. Deals are falling apart right now at funding because of this issue. All right, again, if you have questions, post it in the chat box. Why are guidelines tightening? Guys, jumbo money is the biggest thing that has gone away. And I want to explain to you real quick where jumbo money comes from. It comes from REITs and it comes from major banks. So a REIT is a real estate investment trust. And REITs are illiquid right now. So a REIT borrows money in a short-term loan, but lends it out in a long-term loan. So you can borrow money that you have to repay back in a month or 2 or 3, and the rates are typically really cheap. And when you loan it out for 30 years, the rates are higher, and that's their spread. And all they do is they repay the loans and borrow it again every 3 months. And that's essentially how a REIT works. The problem is that short-term borrowing right now has gotten super expensive. And REITs have had issues with margin calls. And I explained margin calls on the last webinar, so I won't go through margin calls again, but REITs have been hit with major margin calls, and they have basically become illiquid. Nobody wants to buy those mortgages, they can't sell them, and they don't have the money to service them, and they cannot bring on any more. The second source of jumbo loans is major banks. Major banks, you know the big banks I'm talking about, they can't lend as much in large part because of the stress test requirements, because their valuations are dropping, and the rules that were put in place in the Dodd-Frank financial reform bill say they have to have a certain amount of liquidity in order to withstand a stress test. And when their asset values drop, they can't add more loans. So they have to keep more money in liquid funds, and they're not able to lend it out in jumbo loans. So Kathy asked what dollar amount is considered jumbo. And no, I won't do the $1 million thing. So jumbo loans are anything in San Joaquin County that is over $510,000. In the 5-county Sacramento area, it's over 580 something, I believe, 570, I don't know, high 500s. My brain's going dead on that number, but essentially that is the loan amount cap based upon what geographic area that you're in. So 510 in San Joaquin County, 570, 580 in the Sacramento market. Okay, so FHA and VA, those loans are going away, or the low credit scores, I should say, are going away. And it's going away in large part because when we fund a loan, the servicer has to sell the investment on that loan, and people aren't bidding on the investment of FHA loan pools because they're afraid they're not going to perform. The lower credit scores are typically the first ones to be impacted when there is a recession, and that's what the major fear is right now. On top of that, mortgage banks are holding more of this risk, and they have major concerns with forbearance hitting the low FICOs. So FHA, VA low credit scores have almost completely gone away, and I don't expect them to come back anytime soon. All right, so let's fix that. All right, so did I cover that whole thing? Yep, I did. Perfect. Guys, here's the meat of what I want to cover with you guys today, and it has to do with servicing. Servicing is honestly the next domino that's going to fall, and nobody really understands it yet. The media is just starting to understand this issue, but it's been a problem for about the last 10 days. So the CARES Act that was passed allows someone to have anywhere from 3 to 12 months of forbearance. I'll talk in a few minutes from the consumer side about what forbearance means, but from the servicer side, from the business side, it means they're not receiving the payments from the homeowner for anywhere from 3 to 12 months. But guess what? The servicer still has to make payments to the investor, to the Wall Street bondholder. The servicer still has to make payments to the county for property taxes. The servicer still has to pay the homeowner's insurance, and the servicer still has to pay the mortgage insurance. 100% of the payment has to be paid, with the exception of the principal part that goes down, which you all know on a mortgage, you pay very little towards principal. So that's the only piece the servicer doesn't have to write a check for. Let me give you some numbers behind this. If 25% of the homeowners in the United States ask for a 6-month forbearance, then servicers would have to come up with $70 billion to cover the required payments that they have to cover. Mortgage servicers last year only earned $10 billion in revenue. Now, I'm not talking about $10 billion in profit. I'm saying they made $10 billion in revenue, and then they had their expenses from there. So you're talking about 7 times the amount of money that a mortgage servicer brings in annually, they're going to have to write a check for in the next 6 months. And if it lasts for 12 months, then we're talking about $140 billion. Right there, gang, is our liquidity issue. And it's a major, major problem right now. And let me explain a little more detail on why. Because depository banks, your big banks, they can pull money out of their deposit base, or they can borrow from the Fed. The Fed funds rate is almost 0. And so a bank can say, oh my gosh, I've got to cover all these homeowners. I need to write a check for $5 billion to cover all these payments that I'm missing. Oh, no big deal. I've got some extra assets lying over here in these checking and savings accounts. Or I'll go pull some money from the Federal Reserve because they'll loan it to me, no problem. I'm a bank. They don't have a problem. Mortgage banks have a huge problem. I'm going to name some names right now of banks you guys are very familiar with. Quicken, Mr. Cooper, Freedom Mortgage, PennyMac Bank. Actually, PennyMac is a bank. But Quicken, Mr. Cooper, and Freedom Mortgage are 3 of the largest non bank servicers that are in jeopardy right now of going bankrupt. And it's a real jeopardy of going bankrupt. And it's over this issue right here. There's other issues we talked about last week that has to do with margin calls and hedging their new loans and how they're handling their fundings of the new loans. But this is their legacy book of loans. These are people that have done mortgages anywhere from last month to 5 years ago. And these people are creating a burden on the mortgage servicers to be able to write the checks to cover those missed payments. So when Congress passed the CARES Act a week and a half ago, they added a provision. That provision allowed for the Federal Reserve to create a lending facility to support mortgage banks. Just like the big banks can go to the Fed and say, can I have some money, please? The mortgage banks would have the ability to do the same thing. But the FHFA, which is the Federal Housing Finance Administration, the FHFA oversees Fannie Mae and Freddie Mac. The FHFA, the Fed, and the Treasury are refusing to create that lending facility. And nobody knows why. But they've had the option to do so, and they have not put it in place. I've been reading a lot of things from a lot of people, gang. It is my opinion, it's my strong opinion, that they want to let a few of these mortgage banks fail before they jump in and save the day. And I think it has a lot to do with, if we go back to 2008 and what happened when the government stepped in and bailed out the banking system. And everybody said, oh my gosh, you know, the banks and the government are in bed and the government's going to take care of the banks. And it's a political issue that Washington, D.C., specifically the White House, does not want to be seen as coddling the banks and saving them or bailing out the banks if there isn't really a problem. Well, how do we know if there's a problem unless somebody's been harmed? Okay, so I believe they want to see some banks fail, some mortgage banks go out of business so that they can prove there was a problem. And I'm going to give you a good analogy to think about here. Think about back in the beginning of February, and I'm going to make some political statements, please. I'm not saying this politically, but I'm just giving some context. Back in early February, President Trump said he wasn't going to allow any flights from China. And there were two arguments, people saying, hey, that's a great idea, and people saying, how dare you do that? And there's no good reason for you to isolate and stop people from flying in from China. Yet here we are 2 months later, and we are on complete lockdown. And I'm sure if you ask some of those people right now, if they wish that President Trump had done a greater lockdown back in February, they would say yes. But the problem is nobody understood the crisis we were dealing with until it hit them in their own backyard. And so nobody would have supported him shutting down the borders back in February. Just like nobody's going to support the president bailing out the banks until some banks fail. And that's exactly what I see happening right now. This will have, and I saw a couple questions, I'll get to those in a second. Guys, this is going to change the landscape of how mortgages are viewed as an investment going forward. Because right now, mortgages have the implicit backing of the federal government. And yes, the government will back these mortgages. The homeowner they don't win the mortgage lottery if their servicer fails. It gets transferred to a different servicing company. They also there's no major impact to the homeowner other than an inconvenience of changing who they write their check to. But the problem is that it's going to create problems for mortgage banks down the road saying, do I really want to be in the business of holding this debt and servicing these loans when the government won't be there to help me out when everything goes awry? And so that's going to make mortgages less valuable. And when it's less valuable, it means we have to charge a higher interest rate. This will have long-term implications. All right, so Kathy said, is this why the banks aren't letting loose of the money? I've heard a couple of people that said the bank wouldn't let them draw out more than $500. That's more about a liquidity thing about, what was it? It's a Wonderful Life movie, and we saw the run on the bank. The banks don't have all of our money. Like, we give them our money in savings and they turn around and they loan it out. And so what the banks don't want is everybody walking in and saying, hey, I want $10,000, please. They don't have the cash to give it. So no, I don't think it has to do with mortgage servicing. It has to do with literal cash. Like, their balance sheet is not all liquid assets they can hand over. Their balance sheet is full of accounts receivable, which is mortgages, which is any kind of loan, credit cards and car loans, et cetera. Kathleen, you said, what will that mean for the industry if they go bankrupt? You said that if Quicken goes bankrupt, we would be in trouble. So two things. First of all, it doesn't mean anything to consumers other than an inconvenience of who their servicer is and having to transfer the servicing. As an industry, I think I kind of talked about it already, it's going to create a major change to the value of mortgage servicing. And yes, Beth, I am dating myself with It's a Wonderful Life. Okay, so it was, it'll change the value of mortgage servicing long term. And honestly, it's going to create major problems today, because guess what Quicken was supposed to do the day after they went bankrupt? They were supposed to fund that mortgage for that home seller that you have their listing, and Quicken's supposed to fund the loan. And if they go bankrupt, that loan goes away. That loan that didn't fund. It has to start over with John King. Mind you, it has to start over with John King. Not a new bank, but it has to start over with John King. So that's the other side of it. You're going to have significant delays in closing escrows, and you're going to have to now start worrying about what's the next bank to fall. And you're going to have problems with accepting offers. Who knows? I mean, at a certain point, how do you know who to accept an offer from? Because how do you know if that buyer is using a lender that's on the ropes? Because nobody's going to tell you until literally the day they can't fund their loan. And so it's going to create major ripple effect for you guys in the short term as well. All right, Kathy and Kathleen, any further questions on that, or did I answer your questions? So we're going to see more homes go back on the market due to loans not going through. We're already seeing it. I'm hearing about it. I'm hearing about people, that we're having home, especially with the verification of employment issue, we're having deals that can't close because people are losing their jobs or they lost part of their income. I'm hearing many of my clients that have had anywhere from a 10 to 25% reduction in income, even though they're still fully employed. Their employers cut back their salary, and that can impact our ability to qualify them for the mortgage. So for a lot of reasons, I think we're going to see some houses come back on the market. So that's it for the servicing side of it, guys. I want to be clear on this because this is really the piece I need you guys to understand coming out of this webinar. Servicing is a major problem right now. The value of servicing has gone to almost zero. And I hope that I am wrong, but I firmly believe we are going to see mortgage banks, at least 2, fail in the next 30 days. And then and only then, hopefully, we will see the federal government step in and give us some liquidity to solve the problem. I'll say for the benefit of everybody on the call who uses me, and for those of you who don't, shame on you, you can hang up now. Summit Funding is very, very well capitalized. Okay, we have no debt whatsoever. We have significant assets, and so I'm not worried about us being one of those victims. As a matter of fact, we're going to come out of this stronger, but it is absolutely impacting every single mortgage bank. Don't misunderstand. It impacts every single one of us. All right, so now I want to spend a couple minutes talking to you as a homeowner and talking to you about how you need to be talking to your your past clients who have mortgage difficulties. So what if I can't pay my mortgage? Your first option is forbearance, but I need everybody to be clear. Forbearance is postponement, not forgiveness. So you have to pay it back at some point in the future, but it's up to the mortgage servicer and the investor to determine when you pay it back. Sometimes it gets tacked on at the end of the loan. Sometimes you have to pay it back as soon as you stop the forbearance period. As an example, if you get a 3-month forbearance and you get to skip April, May, and June payments, if you are on the immediate repayment plan, then July 1st, you owe 4 payments because you owe the April that was skipped, the May that was skipped, the June that was skipped, and the July that's due. And so we're going to have a major problem come July when we have homeowners who have 4 months of payments due that couldn't afford the payment in April. How are they going to afford to make 4 payments in July? So you need to make sure this is your last alternative, because we also don't know how it's going to impact your ability to borrow in the future. The government's made it clear if you do a forbearance, it cannot be a negative impact on your credit report. It cannot impact your credit score. That's great. But guess what? The industry can find other ways to determine whether you did a forbearance, and that is absolutely a risk factor that they may look at down the road to say whether they'll let you get a new mortgage a year or 2 or 3 from now. It's just like judgments, guys. Judgments are no longer part of your credit report. If you have a judgment, it does not impact your credit score. It came off the credit reports. Judgments don't show up on credit reports anymore. But guess what? I have to now do a separate search for judgments, and I have to see if you have judgments, and it still impacts you. it still impacts your ability to buy a home, even though it's not part of your credit report. So doing a forbearance, I don't know if it's going to impact you down the road. But if you or your clients have the ability to make the payment, because otherwise you could be dealing with unintended consequences down the road that could come from not having made that payment. Randy says, I'm representing a seller. What questions do I ask the buyer's lender? And how do I know he's going to be truthful if I try to confirm the buyer is still working? So first of all, Randy, you're a week ahead, because that's part of what I'm going to talk about next week is really, guys, how do we vet our buyers and how do we vet our offers when we're on the listing agent side? And I'm going to spend more time on that next week going through that, because I think as this world changes, you guys need a better understanding of what to look for. But Randy, the bottom line is, you need to be clear about with the buyer's agent and their lender, have you guys confirmed that this buyer is still fully employed? And you need to ask them what their rules are on how they verify employment at the end of the process, because everybody has to do it some way. And depending upon how strict their rules are, it can impact the timing of your closing. So it's probably the best thing I can tell you is to ask that very clearly. What are your rules for verifying employment at the end of the loan? If the lender has no idea what their rules are, you should worry, because they should fully understand, because if they don't understand, it means they're not coaching and guiding their clients, and they're not asking the right questions of their client, and they're going to get caught by surprise, and that is not the lender and not the deal you want to be working with. All right, so back to the PowerPoint. Modification is the second option that you can look at if you can't pay your mortgage. The problem right now is servicers are being inundated with calls requesting forbearance. And so I've told people a lot, hey, go call your servicer and ask them whether they're going to give you a 3 or 6 or 12-month forbearance and when they're going to want their money repaid. The problem is you can't get a hold of anybody, because they are completely backed up. They have way too many people calling. They are not staffed to manage the volume of calls that's coming in. And so what I'm telling my clients now is, if you cannot make your payment, then get a forbearance agreement in place no matter what the rules are. Then read the rules. And if you can figure out how to make a payment in the meantime, do it. If you can't, then within the next 30 days, call the servicer and ask them to start the process of modification, because modification changes the terms on your loan. Forbearance only postpones the payment. Modification changes the terms, and I promise you, July 1st, everybody who has 4 months of payments due will be calling trying to modify. You need to get in line early to ask for that modification. But be clear, modification has negative credit impacts. If that's the only alternative, that's fine, but just be aware it impacts your credit. So use forbearance and modification only if you have no other choice, and just be aware the long-term impacts are not fully known to forbearance, and it could cause problems with your ability to qualify down the road. Okay, now we're gonna get, I don't know what the squiggly line is. You guys all seeing the squiggly line over here in the middle right? I have no idea where that came from. Jeff probably was trying to doodle and he took control of my computer for a minute. Is that called Zoom bombing? Okay, anyway, Jeff Zoom bombed me with some squiggles. All right, so anyway, why or how does modification affect credit? Modifying a mortgage, the term modification in 2007, 8, 9, 10, 11, 12 was a negative thing. The truth is, modification very simply means changing the terms that were agreed upon. There is a good type of modification. If you get an inheritance of $100,000 and you want to pay down your mortgage balance and then lower your payment to match that lower balance, you can do that. And that modification has no negative impacts because you're able to pay your mortgage. You wrote a big old check. You just want to lower the payment to match what the new balance is. But most modifications, including the ones that I'm talking about, are you saying, Mr. Bank, I can't make the agreed upon payment that we agreed upon in the terms of the loan. And unless you change it, you're going to have to take my house back as a foreclosure. And so can we figure something out, please? And by raising your hand and saying that, you've identified yourself as a credit risk, because you're basically saying, hey, I know I agreed to something in the beginning, but I'm not honoring those agreements. And that is literally the same implication as doing a short sale on a home, because you're essentially saying, hey, I can't afford the payment that I've got, and I need some kind of help from the bank. The difference today is a lot of people have equity in their home. And so I don't know what my advice is right now, and I don't know that anybody's asking for it, but I'm going to tell you anyway. I'm not sure what my advice is on what to tell somebody that says, you know what, I know I'm going to be out of work for 3 months, and I know I can't make my payment right now. Well, they can get a modification, but that's going to impact their credit going forward. They could also just sell the house, and selling the house won't impact your credit because you got a bunch of equity. And the last thing you want to have happen is, and it will happen, you will have people with equity that lose their home to foreclosure. How does that happen? Because if they can't make their mortgage payment every month, the bank can foreclose. And so maybe these people do a forbearance and sell the home during the forbearance period. There's a component there. Again, I haven't fully thought this through. I'm literally thinking about it right now. But if you've got somebody that knows they can't solve their cash crunch issue, then, and they do a forbearance, well, they're no longer eligible for a refinance. I can't pull cash out of a home for somebody who just said, I can't make my mortgage payment. And so maybe they apply for a 3-month forbearance and you get their home sold in the next 3 months. That may in fact be the best choice, so that at least they get their equity out of the home and they walk away with their credit intact. So something to think about, but it definitely impacts your credit score. All right, so business owners need cash. You guys are all business owners, and so I need to give you a primer on this because if you haven't already gotten in line, it is not too late, but it's getting there. Okay, there are 3 ways to get you cash quickly, and I'm going to start at the far right column with the emergency grant. The emergency grant you get by going directly to SBA's website. It's sba.gov/disaster. Okay, you go to the SBA website and you fill out an application. It's actually a single application for both the emergency grant and the SBA economic injury disaster loan, the middle column. So when you apply for that, the first $10,000, and by the way, guys, I'm not an expert. I've read a lot about this, but don't take my information as fact, but I want to share with you what I know, and hopefully it'll help you make some decisions. You can get the first $10,000, as it says, it's a grant from the SBA. There is no repayment required. So you can use that money as a grant. You guys as business owners should all be applying for that. The SBA, the middle option, the EIDL, is another option for you that you can use to cover expenses while your business while you're not operational or not producing the same revenue as you had been previously. Much better option to borrow this money, get in line for it, and then not need it. Pay it back. If you don't need it, pay it right back. But my worry is how long it's going to take to get this money into your hands and what steps you're going to have to take to prove that you're eligible for it. I don't want you to wait until you need the money to ask for it, because it's going to take too long to get it into your hands. So I strongly encourage all of you to go to sba.gov/disaster, apply for the economic injury disaster loan, and the first 10,000 of that is an emergency grant money that does not have to be paid back. The far left option is the PPP, the Paycheck Protection Program. It is my understanding that this is more designed for a broker owner that has a real estate brokerage, not necessarily designed for a real estate practitioner. That's how it's been explained to me, but that's obviously for you guys to get your own information. But what I will tell you is the Paycheck Protection Program is applied for through a bank. So you want to contact a bank locally that does it. I know a few that do, so if you need a recommendation, let me know, and I can connect you with banks that will do this. All right, so that's enough about the SBA system. Now I'm going to bring Jeff, and Jeff has hidden himself. Jeff, you still around? Jeffrey!
Yes, I am around.
All right, it is your turn, Jeff. Catch us up on the title and escrow world.
Yeah, I like that update. You know, there hasn't been much change since the last ones. We do still accept EMDs. If they want to drop it off, we do highly recommend that they wire it in. Still using local notaries. We talked a little bit about the Secure Act on the federal level to try to allow remote online notarization nationwide, but apparently sponsored by 10 large real estate organizations, including the California Association of Realtors and the California Land Title Association. On April 2nd, they just submitted a letter to the governor for a request for an emergency executive order. The challenge with the statute for California is that it doesn't clarify the acceptance of remote online notarization. This could potentially be quicker than the federal Secure Act that they're trying to push through. Because what the California Civil Code currently says, it says it provides that any certificate of acknowledgement taken in another place shall be sufficient in this state if it is taken in accordance with the law of the place where the acknowledgement is made. So I think what they're trying to do is codify and amend the current civil code to be specific on accepting remote online notarization. So currently in the United States, there are 23 states that do remote online notarization, meaning if they enlisted the services of a company that does remote online notarization, let's say in Utah, I think Utah actually does it, that if it's notarized by that company for a transaction in California, that we should have the ability to accept it here. Does that make sense? Kinda?
Kinda.
A little bit? Okay. Wire fraud concerns. I only think they're gonna go up. You know, the amount of attempts and things like that. So we do have our Start Safe portal on refis for the buyer and for the seller. An update on the city county closures. You know, I had mentioned before, you know, the challenge was certified documents. I did confirm on the Superior Court's website that they will take the request online, but they will deliver via mail. So we're in the same boat. You know, I mean, John had mentioned judgments no longer being on the credit reports. Now, if there are judgments against the seller, they will be on title. So if we need to secure or look for in the case file a release or satisfaction of that judgment, I know how to do it online. But in order to request a copy for recordation, I could request it online, but we have to wait for them to mail it to us. And in some instances, it may require, you know, the county courthouse or a clerk there to actually do the investigation of the court case. Most cases I could find it. And then death certificates from the county recorder's office. So be very diligent in the amount of information you give whatever title company you're using. As much information as possible up front. Other than that, we successfully went through March. I didn't really see or experience any difficulties in online recording. Not that it matters, but in the state, there's only, well, there's 23 out of 58 counties that still record by paper. Surprisingly, the closest one to us that is still on paper, Stanislaus County and Alameda. Alameda has some heavy restrictions on recordation as far as when they're dropped off, when their cutoff time is, and if they were to reject a recording, they don't notify via email. You find out at 4:15 when you go to pick up your recordings. Any questions?
Bueller?
I think so. Yeah.
Okay. All right. Good job, Jeff. Thank you very much.
Okay, you're welcome.
All right, guys. So I'm going to cover real quick some educational seminars that I'm going to start doing. So I'm going to do these via Zoom. And I have a event in Facebook for my first one. So my first one's going to be Thursday night at 5:30. Register under Facebook, John Lone King Events. I'm going to be talking about how to buy your first home in 2020. Guys, things are changing. The information I'm giving you, your buyers need that information. If you've got somebody thinking about buying a home, on the bubble, not sure, or they're 100% sure, they just have questions, send them to my event. This is a realtor neutral event. So I will not be talking about it. I'll be the only one presenting. There'll be no real estate agent. There won't be any conversation about, you know, using a specific realtor, because my intention is to send both my clients and yours to one place to get really, really good information. And so find it on Facebook, share it for me, invite your buyers, because it'll be really, really good information. I'm going to also be doing future events, how to sell and buy another one at the same time. I'm surprised on a regular basis how few homeowners understand the process when you own a home and you want to buy another one to replace the one you're in. They don't understand how the financing works, contingencies, timing on that stuff. Do you sell the house first, or do you buy the new house first, or do you try and do it at the same time? To you and I, this is really normal stuff. But to the people that are living in the home right now, they're sheltered in place and they hate it. because either it is too small and they can't take it, and as soon as they get out of the shelter in place, they want to buy a bigger home, or it's too big and they realize they need to downsize because we're heading into a recession theoretically. We are going into a recession, by the way. It's a question of how deep it's going to be and how long it's going to last. And as we go into a recession, you got people that need to downsize. And so this is a great opportunity to send people to me to educate them on that process and help them be ready when it's time to change from a bigger to smaller or smaller to bigger home. A lot of people are talking about investment properties right now. Warren Buffett says, I buy when other people are scared. So now is a time when a lot of people are scared. And so if you're thinking about buying investment properties, it may be a good time to get in and buy some investment properties heading into this market, or at least get your ducks in a row so that you're prepared. If you think value is going to fall further, that's entirely up to you and the buyer, but I can at least help them get prepared on things they need to know. And then I'm also going to do one on what questions that they should ask when refinancing their home. So hopefully that has some good value to you and your clients. I want to open it up. We've got 9 minutes left. I'm happy to end early. Feel free to unmute yourself if you want to ask me a question. Feel free to type into chat if you want to chat a question. And remember, if you want to get a copy of last week's video, you can go to youtube.com and search for John Lone King. Last week's webinar is on there if you missed it. If you want a copy of today's, I'll be posting that as well by tomorrow, so that you can share that and help me spread the word about this event, about these webinars, because I really think this is good information for your peers to understand, and I'd love the opportunity to help them understand all of these changes. Well, gang, it looks like nobody has typed in a chat request. So at this point, I am going to say thank you for your time. Thank you for your attention. Hopefully you find this valuable. Jeff's waving goodbye. Guys, have an amazing week. If you want to come again on Wednesday, it's at 11 a.m. on Wednesday, and then it'll be again 3 p.m. next Monday. I strongly encourage that you all come at least once a week and tell a friend about this. They can go to RSVP with John to register. RSVPwithjohn.com to register. Have an amazing day. Bye, everybody.
Did you connect with Terry?
Hold on.
I got you.